Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to learn about option spreads. An option spread involves the purchase of one option and the simultaneous sale of another. The option contracts will have different strike prices or expiration months, or both, but will share the same underlying. The difference between the two contracts is referred to as the spread. Each option position is known as a leg of the overall strategy. Simple spreads such as vertical and horizontal spreads stand on two legs, and complex spreads such as butterflies and condors have three or more legs. This video will focus strictly on simple spreads. Depending on the sophistication of the trading platform, certain brokers will allow you to enter both legs of the strategy simultaneously, and others will require you to enter them as separate transactions. There are many types of option spread strategies, but typically they fall into three categories: vertical, horizontal, or diagonal. These types of spreads can be distinguished by how they are constructed. A vertical spread involves the purchase and sale of calls or puts with the same expiration month, but with different strike prices. A horizontal spread involves the purchase and sale of calls or puts with different expiration months, but with the same strike price. And diagonal spreads are constructed using calls or puts with both different expiration months and strike prices. Option spreads can also be referred to as credit or debit spreads. If the option being sold is more expensive than the option being purchased, the trade is considered to be a credit spread. Conversely, if the option being purchased is more expensive than the option being sold, the trade is considered to be a debit spread. Investors will select an appropriate spread strategy based on their own unique objectives and market outlook. A debit spread is typically used to profit from a directional move in an underlying security, while a credit spread is typically implemented to generate cash flow under conditions where the investor feels that there will be a very little movement in the underlying security. The risk associated with a credit spread corresponds to the difference between the strike prices less the net premium received. On the other hand, the maximum risk of a debit spread corresponds to the net premium paid to establish the strategy. The profit potential of a credit spread is limited to the net premium received from establishing the strategy, while a debit spread's profit will correspond to the difference between the strike prices less the net premium paid. Note that investors must have a margin account in order to establish option spread strategies in their trading account. Also remember to verify the margin requirements involved with the various option spread strategies before implementing them, as they may differ from one brokerage to another. Let's now look at the three main categories of spreads independently. As previously mentioned, a vertical spread is constructed using option contracts with the same expiration month but with different strike prices. A vertical spread can either be bullish or bearish and established at a credit or debit. The table displays the four vertical spread strategies and the market outlook associated with each of them. In addition, the table shows how each strategy can be implemented using calls or puts. Vertical credit spreads will typically be established in the following way. For example, when establishing a bear call spread, the premium received for the short call will be greater than the premium of the long call with the higher strike price, resulting in a net credit. A bull put spread would also result in a net credit. However, remember that the lower strike put option is purchased and the higher strike put option is the one that is sold. It is important to remember that a credit spread will typically be used in order to generate income. Inversely, when establishing a bull call spread, which is a debit spread, the premium received for the sale of the call with the higher strike price will be smaller than the premium paid for the purchase of the call with the lower strike price, resulting in a net debit. A bear put spread would also result in a net debit. However, the put option with the higher strike price would be the one purchased, and the put option with the lower strike price would be the one sold. It is important to understand that when looking at vertical debit spreads, the premium of the option sold serves as a way to offset the cost of the long option position. Note that each of these spread strategies are discussed further in the bullish and bearish spread strategies videos. The next type of spread is the horizontal spread, which are also referred to as time spreads or calendar spreads. As previously mentioned, horizontal spreads are constructed using option contracts with different expiration months, but with the same strike price. Calendar spreads are established in the following way. An investor would sell the near-term option and purchase the long-term option. Because long-term options are typically more expensive, calendar spreads are almost always established as a debit. When the near-term option is the one purchased and a long-term option is sold, the strategy is referred to as a reverse calendar spread. Reversed calendar spreads are not as commonly used as they have important margin requirements. It is important to note that because horizontal spreads are composed of options with different expiration months, the outlook changes as the near-term option expires. With that being said, in the case of the calendar spread, investors expect stability in the price of the underlying, causing the short-term option to expire worthless. The premium collected partially offsets the cost of the long option purchase to capitalize on a longer-term bearish or bullish outlook. Note that horizontal spreads are explored in depth in the calendar spread video. The last type of spread is the diagonal spread, which is a combination of a vertical and horizontal spread. This strategy can also be constructed using either calls or puts with different expiration months and different strike prices. Diagonal spreads are very much like the calendar spread. The main difference lies in the near-term outlook. An investor who uses diagonal spreads as opposed to calendar spreads will tend to have a more bullish or bearish near-term outlook than the investor who elects to use calendar spreads because of the use of the different strike prices.